Hi, I'm Beth Gaddis, the Editor-in-Chief at Planet DDS. Thank you for joining us for today's discussion on securing DSO financing. Discover what PE companies want to see before investing. I'm joined today by two of the best in the business. We have Lori Diedrich, who is the President and COO of Riccobeni Associates Family Dentistry. That's a fast-growing DSO with 75 affiliated practices. And it was one of the few large DSO groups to secure private equity funding last year. Lori, welcome.
Thank you.
We're also joined by Eric Pestan. Eric is the director at Skytail Group. That's a management consulting and M&A advisory firm that helps scale and sell dental groups. Eric was previously the co-founder of a DSO that grew from 1 to 45 locations. So he's been on both sides of the fence on this and has a lot of great input to share with us today. Eric, welcome.
Great. Thanks for having me.
I'm really excited for this conversation. You know, it has been such a tough market for M&A. I feel like every conference that I go to is absolutely what the panelists are always talking about. So Eric, why don't you begin by just kind of like laying the groundwork for us as to what's been happening in the M&A market over the past 2 years?
Sure. I think as you said, everyone was expecting things to change this past year, and including more transactions to take place, and we've seen quite the opposite. You know, we're still in that holding pattern in a lot of areas. We're seeing diligence taking longer than normal, and an increased scrutiny on a lot of the different areas of each of the DSOs or group practices that we hadn't in the past. So, you know, we are seeing groups really focusing on what you're hearing over and over again, which is same-store growth and various other ways to vertically integrate their practices so that they can be more attractive.
Lori, I mean, as one of the few large DSOs to actually have a successful transaction last year, can you kind of lead us through what that process was like?
Sure. It was long, as Eric mentioned. You know, diligence took a long time, and just, you know, finding the right partner on our end, and then, you know, the partner selecting us. It's very arduous. There's just a lot of information that needs to be exchanged, and so, you know, it was time consuming. It was exciting. It was gratifying in a lot of ways. You know, it's nice to kind of look at yourself from the perspective of someone who doesn't know you, and to kind of you know, see all the things that you're doing well in that lens. And so in that way, that is you know, it's a gratifying feeling. And then there's other times when it's sort of like, oh my gosh, they just asked us 6 questions that we didn't know how to answer, and we really should know how to answer them. And, you know, so and at times it was the opposite.
You know, that's one of the things that I hear often as to what can kill a deal is that they can't get the information that they need. Lori, can you kind of talk us through some of the things that you feel like you had done right that made it easier for you to actually have a successful close?
Yeah, I mean, I think, you know, again, it's all about who you're partnering with. And so, you know, we were fortunate to have a really amazing investment banker helping us. And so helping us to be prepared and to make sure that we knew what we needed to get together, but also just in our platform, we are very integrated in terms of our technologies and our data infrastructure. So it's, you know, I'm not going to say it's easy, but it's easier than it could be to gather the necessary information that was required for them, so that was pretty seamless.
Eric, do you find that can definitely be a driving factor as to whether or not there's a successful close if they have a standardized system in place, a standardized practice management system, for example, standardized analytics, so they're able to get that data?
Yeah, I mean, I think it signals an intentional approach to the business, right? And it signals that, hey, you know, we understand our business, and the data that you see presented before you has a high level of integrity. You know, one of the questions that I think came in is what can we do to prepare, or how do we know we're ready? And I think a big piece of that is looking at your organization from a holistic standpoint to make sure that not only do we have the technology and the infrastructure and the systems in place, but they all make sense when you look at it all laid out on a piece of paper, or, you know, a slide deck or pitch deck in that sense, because it has to make sense. And that's the way to understand whether this business is worthwhile investing in or not. And, you know, the conservative nature of investors today is such that if they see that, this was put together haphazardly or the data doesn't have a high level integrity, that's enough to have them walk away from the table in a lot of cases.
Lori, I think that's really such a good point. You have 2 practice management systems across your 75 locations, and then you have a data analytics platform on top of that consolidates all of the data. How crucial was that to you being able to have a successful close, for you being able to show that you have that maturity as an organization?
Yeah, I think it was really critical. We use both Denticon and Dentrix Ascend across our platform. And then we have Jarvis overlay on top of both of those, and being able to extract the data in a way that was cogent and sort of, has consistency across those metrics really makes a big difference. They're going through their own processes as the investors in terms of their own Q of E, their own Q of R, their own, figuring out, poking holes in all of that information. So the more, consistently it can be presented from those practice management systems. Obviously, lots of information is being presented from accounting systems and payroll systems and lots of other systems as well. But the more consistency that there can be amongst those platforms, the more credibility, I think, lends to what they're buying.
One of the questions that came in is, are private equity companies more interested in total revenue, or are they more interested in like net income and EBITDA?
Yes.
Both.
I mean, I think that, top line is really important. And also there's lots of different ways to define profitability and EBITDA. So, and again, I mean, no one's going to pull the wool over a buyer's eyes. Like, they're going to figure it out on their own, what's underneath all of what it is that you're trying to say your EBITDA is. So there's no hiding in any of those numbers, but I think both are important. I think same store growth and the ability to show successful growth over time is really what is most important, to show that it's replicable and that you're going to be able to continue on that trajectory, depending on, what their goals are for their purchase. But, having that demonstrated track record that you've been able to show ongoing sort of top line and bottom line growth is what's most important.
Yeah. And just to piggyback on that, I think, $20 million of EBITDA is different if you have 25 offices than it is if you have 10 offices, right? And so it's really about the opportunity for those investors when they come in. And, part of the diligence is a pretty intense quality of earnings. And, that's really where the rubber hits the road and they start to understand a lot of the value that would be placed on the transaction. So, I think in a vacuum, those numbers are important, but more important is that, and what I always tell my clients is that you have a beautifully run business that's well prepared to grow in the future. And so it's not only about what it's worth today, but where can we take this into the future, whether it's a platform that can stand on its own or whether it's a tuck-in for an existing platform. And those buyers are very different. They have different profiles. You really can't guess which one is going to come to the table ultimately. So having a practice that's sustainable for the future is really the most critical part about presenting yourself in a positive light for a transaction.
Well, let's say that I'm a seller, right? And I'm thinking about going to market. How do I know that I'm at that level that I'm going to be marketable? What are the things that I should be looking at, and what are the things that I should be doing now? And can you talk to me a little bit about how far in advance of going to market you should start getting things ready?
You want me to start, Eric? You want to?
Feel free.
Well, I was just going to say, I mean, I don't think you can ever be too early in preparing because there's a lot to prepare for. And I think that the more you can demonstrate that sort of integrated, cohesive system that is replicable as you grow, the more impressive it will be for a potential buyer. And what they don't want to see is sort of things just thrown together for the purpose of a sale. because that, again, will be very transparent. If, it just doesn't take much to be able to see through that. And if you're building for the right reasons, which shouldn't really have anything to do with being able to sell yourself at some point, it's more that you're doing it for the right reasons for your business, then that will be sellable at the end of the day, and something that is replicable.
Yeah, and I think the only point that I'll make is that in order to run a good business, let's say, the more attention you're paying to clean financials, good data, great culture, all of the pillars of your organization, the sooner you start on that, to Lori's point, the more effective you're going to be in growing your business, and you're going to be able to grow faster and not have to rebuild or tear down and reconstruct or depend on some sort of acquisition yourself in order to bring in those elements. So I think that telling a good story also relates to having a good track record. That story can't have begun 6 months ago. It has to be something that has shown stability throughout the different economic cycles, throughout, it's okay to fail as long as you recognize it and can define the reason why and have fixed it going forward. So all of that really comes into play throughout that diligence process, and will enable you to really withstand that extra scrutiny that's taking place today, and ultimately delivering the value that you go in expecting. Lori told us they had a great investment banker, but there have been situations where there have been these really high valuations because they wanted to get that higher turn or whatever it comes down to. But then when you see it for the reality of what it has been cobbled together, or it is really disparate owners that have, one system overlaying it. And in reality, there's going to be a huge lift from a integration perspective from a buyer. So the sooner, again, you start on this, the more chances you're going to have to optimize your business to create value and cash flow in your day-to-day management, but it's also going to make you more attractive ultimately when you get to the point of wanting to sell.
Just last week, I was talking to the technology advisor for one private equity company, and he was telling me that they had evaluated 3 deals recently, and 2 of them they walked away from because they had disparate systems, and they just felt like the amount of investment that it was going to take to standardize all of their systems, bring them all up to the level of maturity that they wanted, it's too great of a risk and too great of an investment that they wanted to be making post-sale. Eric, have you seen that as well?
Yeah, for sure. There's all different types of ownership structures out there. Today we see a lot of JV partnerships coming to light. And sometimes it's a little bit more difficult when you have an owner to get them to go through that change. And some of the DSOs today are mandating that be the case, and other ones are being a little bit more lenient on what technology they have to adjust to, and others that they don't. What we're seeing is that the more cohesive an organization is, no matter what the ownership structure is, the more it's really standing up and clearing some of those hurdles as it relates to diligence and ultimately transacting. So yes.
Lori, you have a background in private equity as well, don't you?
I've worked with different private equity firms, yes, in my dental travels.
Do you feel like there's been a sea change from the idea of like rack and stack EBITDA to what we're talking about now with this heavy due diligence, long processes, and really looking for that standardization, things that might be more turnkey?
Yeah, I think for sure. And I think what we experienced in our process is the some of the things that were attractive to the investors in our platform was just the team, the management team, and sort of the investment that Dr. Rick Benny had made over the last 5 years or so in really putting together a really strong team that transcended him, right? So, that was something that was really important. The culture that we've developed that has created really strong dentist retention, really strong hygiene retention, different types of hygiene models, those were things that were also really attractive in the sale. So aside from the data and the numbers, I think there's other things that make a DSO or a dental office or a dental group attractive to a potential investor. And then I think on the flip side, I would say, before we even went into the process, our executive team was very clear about what we were looking for too, so that, it's not just what do we need to do to sell ourselves, it's what are we looking for in the right partner to make sure that we didn't see erosion in the culture or in the retention or in the management team. Those are things that were really important to us to retain in the next partnership that we entered into. And so, we were also trying to vet the right partner to make sure that those things would be retained.
I'd love to have you talk a little bit more about that, Lori, and then Eric. What are some of the questions that you should be asking as you're going through this process to make sure that you have that kind of cultural alignment in place?
Yeah, I think internally we were asking ourselves, like, what are some non-negotiables, right? Like, what are some of the things that, we want to make sure that we talk about up front, so that it's not left to chance after the fact. Simple tactical things like, how many hours a week do you expect us to be in meetings with you? Like, we have a business to run. Like, how much time do we need to spend with you guys as opposed to kind of doing what our actual day job is? What are the reports that you're going to require? What happens when the business isn't performing to budget? What's your process? What are the things that you're going to ask us about? So we wanted to be transparent and upfront about bringing some of that to light before we got to the other side, just to make sure that, obviously everybody's putting their best foot forward during the process. And so then when you get on the other side, then we're all getting to know each other again. Right. So, and that's completely fine. But I think it's helpful to have had those conversations in an open forum, so that, just because I think it's helpful for them to also understand what's important to us.
Eric, do you want to add on to that?
Yeah, I think a big piece of it too is making sure that your projections. So, if we are the platform and we have an investor deck and we're presenting what we think growth can look like in the areas that we can expand and provide ongoing value for the investor, that those are realistic too, because we're going to be held accountable to them on the back end. And so, like Lori said, what are the expectations from both sides, and where do we want to be, 6 months from now, 9 months from now, a year from now, so that there is alignment. And so that initial transition period, once the transaction is complete, is as smooth as possible, so that you do go through this with your eyes open, understanding expectations from both sides, is what makes this the clearest path. And the only other thing that I would say is that a lot of these investors are coming with a platform or with other portfolio companies. And so don't be shy to ask to talk to some of those, companies, whether they're in a similar space or not, but what their experience was and some of the struggles or successes they had, so that you do get an idea, from the horse's mouth of what working with this company looks like on the back end.
No, Eric, you just mentioned that a lot of investors are coming from other, either in the dental industry and they have other platforms already, or they're from healthcare. Do you feel like they are becoming more sophisticated about evaluating a group's systems because they might have that background knowledge?
Yeah, even the ones in dental specific, I think, have become a lot smarter over the years about, what a successful DSO looks like, or a successful platform or group, or whatever you might be today. And that's a big reason of why diligence is more sophisticated and longer, because they know what rocks to look under, what pages to turn, what questions to ask, and some of the issues that have come up in some large transactions in the prior years. So yeah, I think that everyone kind of talks about the episode in kind of innings. And so, whether we're in the middle innings or the late innings, we're not in the beginning innings anymore. And so as time has gone on, sophistication has followed for sure.
Lori, what would you say would be like the biggest red flag in diligence, especially as it comes from looking at it from an infrastructure point of view?
From the investor?
Yes.
I think that, I mean, I think that there's probably a couple things. I think, like to your point earlier, Beth, that you said that you had spoken to somebody at a private equity firm, you know, when they're seeing like a whole bunch of disparate systems that ultimately, in order to create that long-term value, would have to be integrated, that's just a huge expense. I think also on the technology front, seeing a DSO where there hasn't already been a lot of good investment in technology, whether that be data platforms or just, you know, clinical technology, you know, those are huge capital expenses that would be required upon a purchase. And so seeing that a lot of that's already been done, I think is very valuable and probably a red flag if it hasn't been done. I think, you know, high turnover is a big red flag for, you know, purchasing any kind of a company where, you know, you do want to sort of evaluate why is that happening. So those are a few that come to mind. Oh, we might have lost Beth.
Maybe.
Eric, do you have more?
Well, so I was going to say, when we were out in California not too long ago at the Planet DDS at their home office, we had a roundtable and we were talking to some of the RCM teams that were there, and they were talking about unapplied credits being a huge red flag. So they do, you know, they dive that deep. They're looking at your ledgers. They're seeing that there's all these liabilities out there that we don't know why. There's no good explanation. And at the end of the day, it could cost them millions of dollars, if not legal issues. And so I think that there are, again, a lot of different areas that might be caution or red flags. And you just have to make sure that you do a good job on the front end. Again, you know, taking your time to make sure that that we are running a clean process. And I think, you know, when those types of things come up, because they're gonna dig and they're gonna find things. And so as long as you're honest through the transaction and you have a reason why these things might be there, or a perspective on how we're going to change it moving forward, I think you can survive. It's when you start to make up answers or not have answers where you tend to run into issues or problems or troubles. So
yeah, I agree. I think there's no hiding, right? Like it has to be transparent on both sides. Otherwise, one side or the other will walk, because there's no advantage to not being transparent.
Of course, I totally agree.
Short term or long term. So what are you typically doing with your clients at this point? Like, are most of your clients on the buy side or the sell side?
So our clients on the M&A side are on the sell side. I work more on the management consulting side. So a lot of kind of what we've been talking about, preparing and building and making sure that our clients are optimized to be budgeted properly. And that's another big thing that I think can show buyers that not only has there been a consistent approach, but there's also been a plan in place throughout the prior 5, 10, 15 years. You know, in my case, we were operating for 15 years, and we were always operating under a budget and had plans. And, you know, you could see the years that we hit the budget and the years that we didn't. And there was a thoughtful approach to why we did and a thoughtful approach to why we didn't. And you could see adjustments in the ensuing years to make up for that. And so, again, you know, we work with a lot of our clients to make sure that there is that thought that goes into their business and understanding, and ultimately setting goals and making sure that we can that we can hit them.
Mm-hmm. Yeah, that makes sense.
Oh, looks like Beth is back.
I was just going to say, we lost her in the Florida thunderstorms.
I cannot believe that just happened, everybody. I am so sorry. We had a thunderstorm that just popped up here, and so that was that. But fortunately, the internet just came back, so I'm sorry that I missed that.
No problem.
So just wanted to ask a few more questions that had come in while I was off and away, actually. And the first one is, now, how do you avoid a deal falling apart during due diligence? What are some of the things that you can do proactively to make sure that you have everything that you need? Eric, do you want to take that one?
Again, I mean, I think a good investment banker prepares you in the right way to be able to understand and really does their job on the front end to try to prevent that from happening. Inevitably, deals fall apart, like you said earlier. There have been some this year that have fallen apart for various reasons. I think all you can be is honest throughout the process and answer the questions that you're asked and discuss it in a way that isn't going to put you in a tough spot if that transaction goes through. And so ultimately, I think it's a responsibility to your business to run it the right way, but also a responsibility to the investors to be honest throughout the process.
Absolutely. Lori, do you have anything else that you'd like to add as somebody who recently went through this whole process?
Yeah, Eric and I were just kind of talking about that when you were lost in the thunderstorm. But just the transparency, I think, on both sides is super important. And there's just really not any place to hide, and there's no advantage to trying to hide. Like, just being honest and getting everything out on the table up front is just going to help build the relationship after the deal closes.
So what do you do if you are a DSO that really haven't, like, you don't have your ducks in a row yet? I mean, do you start looking now at consolidating and standardizing technology, or do you start looking for and put off that idea of recapitalizing or having an exit event maybe 3 to 5 years away? Like, what advice would you give to people that might not have the systems in place or might not have the culture in place?
I guess I would start by asking, like, what is the goal in looking for an investor? Because I think most of the time, hopefully what we're looking for an investor for is to allow the business to continue to grow. And so in order to do that, you probably have already had to build something replicable, right? Like, you have to have that infrastructure and those core systems and the technology integration and the things that we've been talking about really need to be in place in order for you to continue to grow, whether you have an investor or not. So, I think that if you're looking at it as far as, like, what do I need to do to be able to sell my business, that might not be the right order of questions. Like, what are you doing in order to grow your business without needing an investor? And then once you get to the point where you want to continue to grow, you'll probably be ready to get an investor. Not that it's simple, and I don't mean to make it sound simple, but it just seems like that sequence is important.
Eric, and that's when SkyTail becomes involved a lot. You are a consultant. So talk to us a little bit about when you're going into a group, what are you evaluating and what are some of the steps that you often advise them to take?
Yeah, I mean, I think as a business owner, it is highly advisable, especially if you have that premonition in the back of your mind and those things that you kind of just listed off, is to understand how difficult a transaction might be if you have some of those issues. If you have disparate systems or something that is more technical, that's probably an easier fix maybe than bad culture. If you're sitting here saying I have bad culture in my organization, you're in trouble, before you even think about a transaction. So, it's what are these things that we can concentrate on and what are the indicators really of why this is happening, and how can we focus on, because I think as a business owner, especially when you have multiple locations, it can be hard to see the trees for the forest, right? And so you have to really get into the minutia and the detail and really start leaning on your operations team to understand what it is that's driving this negative effect throughout your organization, and then really be able to diagnose it and then figure out what the cure is. And sometimes that can be done internally. And sometimes it is nice to have external eyes, either to do evaluation or to give you some sort of commentary around, hey, these are the things that are going to prevent you from hitting maximum value. And maybe you're okay with some of those and maybe you're not. But at the end of the day, I think you need to understand your company regardless if you're going to go through this process. And if you have that kind of perspective coming into it, I would argue you don't understand your company well enough, and you need to figure it out quickly if you're thinking about a transaction.
Well, Lori, now you're on the other side of it, and now you are growing and expanding and acquiring other practices and groups. Tell me what you're looking for as you're on now the buyer side.
Well, we've been on the buying side for a long time, even before the transaction, but yeah, for sure. We are looking for the same things that we knew were going to be looked at of us. I mean, we want to know, are we buying something that has opportunity, and are we buying something that we can bring value to? So, we want to find those synergies where we're locating practices or groups where the systems that we have built can help bring that practice farther along and continue to grow it. Sometimes that's just having the capital to expand the physical location, and sometimes that's technology, sometimes that's practice management system. It just depends. But really wanting to find those value add situations that will allow us to continue to grow our brand in the way that is important to us as well.
Fantastic. Eric, any last words of advice that you would like to give to anybody who is watching?
Yeah, I think at the end of the day, it's really about, again, I think we really hit the nail on the head. Understand your business, run it as if you're never going to sell it. And then you'll put yourself in a good position to sell it when that time comes.
Lori, your final thoughts?
I think Eric said it very well. Just, run the business in the best way for your employees and your patients, and you'll probably have a successful transaction at some point.
Well, thank you both for joining us today. I really appreciate you taking your time and sharing your expertise with us. And once again, I apologize for the thunderstorm. That is, it's like live TV when I used to be a TV news producer. Some things are just beyond your control. But everybody who is watching, thank you so much for joining us today. For more information on how you can grow your business and have all of the practice management tools that you need, please visit www.planetdds.com. And we have tons of resources there available to help you. Thank you so much.
Thank you.
Appreciate it.